This is exactly why most ICT traders are failing to get the most out of the setups they're taking. In today's video, I'm going to show you how to change that. So let's begin. We're going to be talking about the refined risk model. Now, what does that mean and what does that entail? Well, to put it simply, no doubt about it, ICT concepts, smart money concept, fair value gaps, order blocks, these things are repeatable. We can look back through pretty much any price chart and we see examples of this stuff working time after time after time again. The question is it going to work for your specific risk tolerance? Because structure is just that. Wow, you see something where price is validating off of that. How can you personally base an entry off of that with a high degree of certainty that you can get a positive outcome with a relatively small stop? To start out, we're going to start with a quote. Be the one who embraces the hard work. It is not a secret that this stuff is very popular. And that means that anyone is getting into this. So you see a lot of people with very, very lazy processes. And they just say, oh, well, I see a level, I buy a level without any sort of regard for the expected outcome. When you are simply just buying it, blindsided, right? You're just diving into a trade with no understanding of whether or not price is actually validating that as a specific level that it's going to reference. I mean, you're going to be lost because at the end of the day, structure is just that. A fair value gap is only a fair value gap until it inverts. And without any sort of context being set, you have no idea what you're doing. You just have a general stop and hope and pray that it works in your favor. And that's what we're going to change today. So today's schedule, we're going to be going over some market structure, the basics, the stuff that I'm sure a lot of you already know. But our goal is to leave here with a better understanding of how to qualify A-plus setups, specifically to intraday trading. Well, for me, it's a futures market. For you, it might be something else. But how to qualify these setups and ensure that you're getting a refined risk. So we'll go over the difference between market structure, risk structure, and ultimately that leads us into trade management. How are we going to capture the most out of these moves? Again, market structure is not the same thing as trade structure. These are two isolated components. There are principles of price action that allow us to hyper-focus our efforts without needing to tolerate large drawdowns. Why do you need to buy the first test? Why do you need to be the first in the market? If you're supposedly smart money, shouldn't you have a better way of validating and qualifying these setups instead of just blindly, oh, I see a level, I buy a level and tolerate all this drawdown and then it works? Why not just wait for it to get to the backside of that move and you get in right there? So let's continue. There's structure points, you can look at these as swing highs, swing lows, things of that nature. You have characteristics of price. So that might be something like a price imbalance, a fair value gap, if you will, or consolidations. We also have reversals, right? This is where markets are changing direction. It's really not that complicated, but there are various contextual methods to identify reversals. That could happen at specific prices. That can happen at specific, you name it. Confirmations. These are things that are validating an existing trend. This might be, order blocks within a price run. But how are we going to use these to develop trades is really what this is based around. Just a quick review on some of the concepts. Right here, you can kind of see that broad candlestick with the no overlapping of wicks. That's going to be your fair value gap. That's your expansion move, right? And what is really the edge in just buying the initial reaction? You should be asking, I understand that price is going to react here in some capacity, but how do I position myself to understand that this right here is essentially all that I need to risk? Do I really need to risk up there? So why would I do that on any time frame is the question. Doesn't matter if that's a daily chart, a weekly chart, a 5-minute chart, or a 1-minute chart. Why on earth do you need to risk all of that imbalanced price? If price is so imbalanced as you truly say, why do you need to have such an uncertain stop? I thought the trend is clearly lower in this scenario. How is that smart money? These are the questions that you really need to be asking yourself when you're consuming this type of information. So on to the next point. These are going to be obviously your swing points. Right here, this is a swing high because you have a candle to the left, candle to the right, and the middle is the tallest one. Opposite is true for swing lows. You got one right there and one right there. They're pretty basic. but this stuff will help you determine market structure, as these are how you see shifts, reversals, things of that nature. So this could be a shift, right? You have price come up, it creates a swing high, swing low. You have many of these, right? When you look at the lower time frames, you'll see stuff like this. Imbalance in price creates a gap. So it's bearish. That would be the assumption, right? But see how this thing peaked above? Someone might say, oh, it closed above, time to buy, and then it continues lower. So what made them say that they needed to get in that trade? Why didn't they have some sort of qualifying criteria? Oh, it just closed over. That's really the best edge you have. You can't determine that maybe this is going to just peak above. Does it need to close within? Like this one clearly wicked above, and it really doesn't seem that it impacted its ability to move lower. So when you're looking at these setups, you got to ask, why would I need to refine my risk? And the thing is, if you tried shorting right here, you're dealing with all this chop, when really you could find a way to get in on this backside right here. That's where the edge is really going to unfold. So continuing on the topic of the refined risk model, we have a couple setups here, and we're going to go over some main ideas from these. So if you look right here, you can see this is an imbalance in price. It's a fair value gap, it goes down, it creates a gap, and you see initial reaction, and there's a number of them, right? Until it eventually flips. We're going to focus on the flip. So these two charts are the same time of day, different time frames. Right here's your initial test of that inversion. Now you might be asking, oh, why can't I just buy that? Well, the problem is this. If you're buying the zone based on the rules of an inversion, you'd have your stop somewhere arbitrarily lower than price. Why does it need to be all the way down there? Isn't there going to be any other clue that it might hold? So you see that this gives you some reaction, but it clearly sells off lower. This is where the idea of Confluence comes in. When you're qualifying an area and price, you want to see more than just one thing go in your favor. It shouldn't be just, oh, I see a gap, I buy a gap. That's like the most pattern trading coded setup I've ever heard of. You need to have like 5 things. The more, the better, right? Why would you say, you know what? I'm going to rest the fate of my future on one idea that I heard from someone one time. Instead of saying, you know what? Let me take the body of understanding of price, the career, the experiences, all of it, and combine it into something that works for me. Why would I limit myself to one tribe? Like how narrow-minded would that be? You should be looking at everything you can when it comes to validating a setup, when it comes to trading. So when it comes to this, you can see multiple confluences. You see a test of a gap, you see a swing point formation, you see an inversion created, you see VWAP aligning with that, and you see structure above that you can target. Now this right here, when you're looking at this to here, that's, I don't know, maybe a 20-point stop compared to a 45, 50-point stop. It's clearly a better trade. There's a higher expected value for that. There's more things that align with it. Why on earth do you need to buy price for the sake of buying price? You should buy qualified entries that have an immediate reaction. Do you really? Oh, I got in earlier. That's great. And you struggled for 40 minutes until it dipped lower and probably stopped you out. And then the real money got in and took it to some sort of logical target. That's the difference. You don't just see the level. That's market structure. I think everybody who has a trading chart can see the same levels as you. You're just having definitions for certain things in price, but it's nothing new. People who've been trading any sort of setup for the last 20 years, they've seen fair value gaps, whether they realize it or not. They're on the chart. Like, for crying out loud, it's not like you have some invisible ink writing on your screen that only you can see. The candles are painted the same for everybody. It's your perception of them that's making the difference. But when it comes to Confluence, that is always going to be true. The more things that qualify a trade, the better it's going to be. So do not limit yourself to one school of thought. Let's look at the second example right here. We can see price comes down, tags Asia low, right? And it creates this inversion. Most traders under the ICT system say the first candle that closes above a fair value gap, an inversion fair value gap, creates a reasonable entry. If you take a step back and look at it and you say, so you want to buy the peak? You want to buy the top? Because maybe it will go higher? Well, so where's your stop? Down here? Why not just wait for some sort of swing point to form? Oh, you're in first right here. And then it goes down for like 5 candles. Where when it goes down to the area, you see the body stay in the gap, which is a good sign, right? And then you see this long wick, boom. As soon as it creates this long wick, it's actually into that lower gap. Then you say, hey, maybe now I can align with an entry above that gap. That might be a better expected outcome. It's clearly a tighter stop loss, right? So because of tribalism, people tend to forget the basics of price action. It's quite simple. Swing highs, swing lows. We can all understand that. So why on earth do you need to structure your entry based on a zone? You could simply refine it to a swing point. And then that creates a stop based around that swing point failing. So it makes the risk or reward a lot more cut and dry. But we're getting to the end of this video. We want to have just some quick thoughts off the top of my head when it comes to price action. If you're not doing everything you can within your ability to get better, you're going to have very, very minimal results. There are so many different people trying to make money in these markets that you think your half-assed effort is going to get you anywhere. You are beyond delusional, and this isn't going to be the thing for you. If you actually want to make it, you have to be willing to do the work that no one else wants to do. That means refining your entries. That means mastering your risk management. That means being able to get the maximum amount of size with the minimal amount of risk. It is cost effective to have tighter stop losses. You need better risk adjusted returns. You're not just trying to make profit for the sake of making profit. There's things that you can measure when it comes to your stats, when it comes to the setups you're taking, and these are metrics that you can optimize. If you're not willing to do that, then you're just going to continue the same path that you've been on of just marginal progress, marginal backstep, maybe maximal backstep, right? That tends to be the cycle. Because people have such low edge in their setups, when they go into a harder market, they truly begin to struggle because there's nothing aligning for them. There's no draft for them to kind of pick up off of. It's them and their mistakes in front of them. When you have a system that has a high degree of refinement, when it has a high degree of precision, there are very, very, very easy setups you can catch. And it all comes to the same idea of just understanding that markets are going to form swing points. And if you're not basing your entries on swing point formation, then you are leaving money on the table. So I hope you got something out of today's video. If you enjoy this type of content, be sure to like, share, subscribe, and send this to a friend that you think might need it. Until next time, take care.